Hello, I'm Carrielyn, your CUNA certified financial coach. And joining me today is Carolyn Vautier. Carolyn is the branch manager of our Waterville location. Carolyn, I'm so excited you joined me this month. Can you tell us a little bit about yourself?
Thank you so much, Carolyn. I'm super excited to join you. I'm actually, the branch manager here at our Waterville location. I came to New Dimensions in about 2021. I joined you guys in your BSA anti-money laundering department. And then from there, I moved over to be your branch manager. I started in finance in about 2011, where I actually was doing mostly customer service. And I moved over to start doing finance in branches. It was super exciting because one of the most exciting things I like doing is just helping members, really educating them about their financial goals and really getting them fitting them into products that help them discover and find out what they really need. But one of the things I really like about New Dimensions is the fact that we really financially educate members on the products that will help them save themselves money and help them to not overspend. And what's one of the things that Americans really do right now is overspend.
Yeah, you were so right.
And I really like being able to see the looks on our members' faces when we really educate them and we help take them from 30% of an annual percentage rate to 12%. And they're not spending $5,000 in interest and they're only spending maybe $2,000 in interest.
You're absolutely right. No, that's the one thing that I like about New Dimensions as well, is being able to educate people, getting them so they can realize that their dreams are possible. And all it takes is a little discipline and a little education, and that really can go a long way.
Absolutely.
Yeah. Well, that is great, Carolyn. Again, I'm so excited that you're joining me today. In this edition of TealTalk, we will continue to dive into credit. We will be focusing on the 5 ways that credit is calculated. A lot of times we hear the word credit and think, we have a good understanding of how important it is to have good credit, especially if we want to finance something. However, not many of us really understand how the score is actually calculated.
Along with those 5 ways, we will also include tips to help keep you on track. Carolyn, what is the most important part of the credit score?
Great question. I will tell you, the only advice I got growing up when it came to credit was you're going to need to finance something someday. Pay your bills on time. Well, that was it. It was also the largest contributing factor to your credit score. Payment history accounts for 35% of your credit score, meaning how well you pay your bills on time. Carolyn, if a person has a spotless credit report and they miss one payment, how many points do you think they lose?
Great question, Carolyn. 10?
Good guess. If a person has a spotless credit report, they can actually lose up to 100 points off their credit score.
Wow, something like that? That's a lot.
That really is a lot.
A 30-day late payment on your credit report not only impacts your score, but the interest rate should you need to apply for a loan, causing you to pay more over the life of the loan.
You're absolutely right, Carolyn. A drop in your credit score can cause higher interest rates on future purchases. Also, depending on the payment missed, your current interest rate could also be affected as well.
Carolyn, what can people do to avoid missing a payment?
Well, there are a couple different ways to help avoid a missed payment. Set up a calendar reminder or an alert prior to the due date or prior to when you need to send the payment out. Set the payment up for automatic payments. This is a great way to ensure that your payment gets made on time. However, it's up to you to have the money in the account prior to the due date. Calendar reminders or alerts can also help you with this. Also, if the due date falls at an inconvenient time of the month, maybe adjusting your due date may be a better option for you.
Wow, something like that. Those are really great ideas. Some companies will even send you texts prior to your due dates as a reminder, and you usually can set those up on their website or their app.
Absolutely. And when it comes to payment history, how you currently treat your payments is more important than any past mistakes. So if you're looking for a way to start improving your credit, the best thing you can do is to start making those on-time payments. Remember, payment history is 35% of your credit score. The next big contributing factor is credit utilization. Credit utilization is 30% of your credit score. When we talk about credit utilization, this is the amount of usage on your revolving lines of credit, such as your credit cards and lines of credit.
And revolving lines of credit are accounts that as you pay the balance down, that money becomes available again.
You're absolutely right. And many of the experts will tell you that you should keep your balances at 30% of your credit line or your credit limit. I always say 25%. It's much easier for a lot of us to figure out what 25% of something is rather than the 30%.
And actually, Carolyn, if you keep your credit line at 25%, you'll always be below that 30%, which will also keep your debt down as well.
Carolyn, you're absolutely right. Using that 25% guideline can help you keep your debt down to a more manageable amount as well.
So, Carrielyn, if I had a credit card with $500 limit, how much should I use?
You really wouldn't want to use more than $125 or let it report more than that.
So with a credit card with a $5,000 limit, you wouldn't want to use more than like $1,250?
You're absolutely right.
When the credit bureaus see that you can manage those revolving lines, well, that helps your credit score, right?
It really does. When I'm working with members on increasing their credit score, one of the first things I look at, other than their payment history, is their credit utilization. If we can pay those balances down to below 25% or completely down to a zero balance, their credit score has an opportunity to increase significantly.
So, Carolyn, do you have any tips for credit utilization from reporting high on the credit report?
I do. A lot of times people tend to pay their credit cards off in full every month. But what's happening is that full balance, even though it's getting paid off every month, is still reporting that balance that is owed. You can actually make weekly payments or even just a larger payment prior to the statement being cut. When the statement cuts, whatever is due or whatever is reporting as a balance, that's what gets reported to the credit bureaus. By making a payment around the middle of the month, it lowers the amount reported to the credit bureau. Another way to help credit utilization is to ask for an increase of your credit line. If you're someone who likes to use your credit card to pay all of your bills and expenses and then just make one payment to the credit card, paying it in full each month, having a higher credit limit is going to give you a higher 25% usage guideline.
Wow, Carolyn, I'm blown away. Between credit utilization and payment history, that is 65% of your credit score. I never knew how important those two factors were when it came to your credit report and the score.
I know. When I go into schools and we talk about credit, I always try to emphasize the importance of keeping their credit utilization low and making sure they pay their payments on time. There are a few more factors that go into calculating a credit score, but these two are really the biggest contributors.
I know the length of time you've had credit can also affect your credit score. I've always heard people say don't close out a credit card or a line of credit because your score could drop. Is that true, Carolyn?
Yes, Carolyn, it is true. 15% of our credit score is based on our credit history, the length of time that we've had credit. So when people say don't close out your card or your line of credit because your score will drop, what they're saying is your score is going to drop because you're going to lose all that credit history. Something I tell people is if you have a credit card that you've had since you were younger, that's really where your credit started. So always keep that credit card or even the credit line open. What's great about these revolving lines is even if you don't use them, they're still going to report as a positive trade line on your credit report. So many individuals that get credit cards when you're younger, they might have a really high interest rate, and then they'll get a new credit card later on in life that might have a much lower interest rate. Don't close out that older card, just don't use it. Or maybe use it every 6 months or so just to keep it active so that way it doesn't get closed out on you.
So if I use my credit card once every 6 months to keep it active, can I still pay the balance due prior to the statement cutting so that it doesn't show a balance on my credit report?
Yes, and I would recommend that. That also keeps your debt to income ratio lower in the event that you're looking to find something at that time. Also, some cards accrued interest daily. You can actually go in the same day that you make the purchase and make the payment to pay it off, helping to eliminate that extra interest.
Okay, so far we have payment history at 35% of the credit score, credit utilization at 30%, credit history at 15%. We're at 80% now?
Yes, and the last 20% is broken into two more factors, one being the accumulation of debt within the last 12 to 24 months. This one really focuses on how often you apply for credit, whether you're approved or not. Every time you apply for credit, a hard pull is shown on your credit report. And when this happens, you could lose 7 to 12 points off your credit score.
If this happens every time there's a hard pull on your credit, what happens when you go to try to buy a vehicle through a dealership and they run your credit through multiple financial companies, Carolyn?
Well, the credit bureaus understand the idea of rate shopping, especially when we're making a larger financial purchase. Because all these credit pulls are done at the same time, the credit bureau understands and will only count it as one credit pull. The same goes when you're trying to rate shop when buying a house. The credit bureau recognizes the importance of getting the best interest rate and actually gives you a 14 to 30 day window where all the credit pulls will only count as one.
And even though it only counts as one credit pull on the credit report, will each financial company be listed separately on the inquiry section of the credit report?
Yes, even though it's only going to hurt your score as if it was one credit pull, each of the financial institutions that your creditors run you through, whether it goes through a dealership or if you're rate shopping for a mortgage, they will all be listed separately on the credit inquiry section of your credit report. However, lenders can see this and they'll know that you are rate shopping. However, if you have a bunch of inquiries, say in the last 3 to 12 months or even sooner, that could be a red flag for lenders. For example, if you had 6 inquiries for credit cards, lines of credit, or personal loans all within the last 3 months, a lender may see this as a financial hardship and may be curious as to what's going on in your life where all of a sudden you need access to all this cash.
Wow, Carolyn, I didn't know that you have time to rate shop a mortgage or that even rate shopping in general didn't hurt your credit as much while allowing you to get the best rate to save money over the life of a loan.
When financing a larger item, it is important to rate shop to get the best rate. I encourage everyone to shop around.
Now we are at 90% of our credit score. What is the last 10%, Carolyn?
The last 10% is having a good mix of credit. And when I say a mix of credit, I'm talking about those installment loans and those revolving lines of credit.
Carolyn, when you say installment loans, for those younger listeners, you mean like a personal loan, a mortgage, an auto loan, any loan that has a set payment with a set term?
Yes, Carolyn, that's exactly what I mean. And having a healthy mix of both can show the credit bureaus you can manage different types of credit accounts responsibly.
So, how can someone use the mix of credit to increase their score?
Great question. Installment loans, such as a personal loan, can be a great way to help increase your credit score. If you find yourself with high revolving credit utilization debt, applying for a personal loan to consolidate that debt can boost your credit score. Restructuring that debt from a credit card or a line of credit into a personal loan is going to open up that capacity that we talked about when we were talking about the credit utilization factor. Those balances will go down to zero. Your capacity is now fully open, and you also have a mix of credit accounts. Another thing about a personal loan is that the interest rate is usually lower than the current interest rate on the credit card or line of credit, which is going to save you money in the long run and give you an end date when the debt will be paid off. And it gives you an end date when the debt will be paid off, kind of like a light at the end of the tunnel feeling.
So by restructuring that revolving credit debt into a personal loan, even though you haven't paid any of the debt off, your score will still go up because the credit utilization is down to zero, Carolyn?
Yes.
That's a great idea. Like you said, not only will their score go up, but they're going to pay less money over the life of the loan and probably be relieved that they have an actual end date. My piece of advice for someone that would do a personal loan to pay off, say, some credit card debt is that they don't use those cards anymore.
You are absolutely right, Carolyn. A lot of times people will do this and their score goes up. And then what happens is they are in such a cycle of using their credit card that they tend to rack those balances back up, putting them in a worse financial situation than they were prior to the restructuring of their debt. Because now they have that personal loan payment and those credit cards are maxed out again with those payments as well. It definitely can take some discipline to not use your credit card if it's something that you've gotten into the habit of doing to help compensate some of your income. This is when having a good budget and a good financial plan is important.
Carolyn, you're absolutely right. Having a good budget and a financial plan is going to be the key in managing their finances going forward. Well, Carolyn, to recap how the credit score is broken down, 35% is payment history, paying those bills on time. 30% is credit utilization, making sure we are keeping our balances on our revolving lines of credit to 25% or below. 15% is based on your length of credit, how long you've had a credit established, and making sure that you always keep your oldest credit card open. 10% is limiting those in credit inquiries and really only applying for credit when necessary, and making sure that we are rate shopping for those larger purchases. The last 10% is having that good mix of credit, showing the credit bureaus that you can manage both installment and revolving credit accounts.
That was a great recap, Carolyn. You're absolutely right. Also, I want to thank you, Carolyn, for joining me on this month's episode of TealTalk. Next time on TealTalk, we're going to discuss the ways you can start building your credit if you don't have any, as well as some more tips and tricks on increasing your credit score. As always, if you have any questions about credit or you're looking for personalized credit advice, contact us at info@newdimensionsfcu.com. See you next time.